Welcome to Pepper Presents Volume 4. My name is Caroline Mirakian, Head of National Accounts at Pepper Money. Today we are looking to discuss how COVID-19 has impacted a lender's approach to underwriting, and then look to provide our key broker partners with some useful tips on how to progress mortgage applications smoothly through a lender who may have tightened up their underwriting requirements due to COVID-19. The learning objectives from this webinar will be to explain how COVID-19 has impacted a lender's approach to underwriting, and then cover off what intermediaries need to know, followed by what opportunities there are out there for our broker partners, and in addition, how Pepper Money can help. Now, don't forget, at the end of this webinar, you are able to obtain a participation certificate from us. Just drop us an email request of which details will be at the end of this webinar. If we take a brief look back down memory lane when the pandemic got sprung on us all originally back in March of this year, the mortgage market shrank quite quickly, primarily only able to support those customers who could pursue a mortgage application via automated valuation, as physical valuations had to be paused whilst we were all on lockdown. And also we saw a number of products reduce. If we look at the Bank of England reports, for May, mortgage approvals had fallen for house purchase to just 9,300, almost 90% below the level in February. Added to that mix, we had specialist lenders as ourselves impacted by limited funding as the capital markets had shut. For those who may not be aware, funding to specialist non-deposit based lenders are made via warehouse lines, securitization whole loan sales. Funding lines play a vital role amid the increasing demands from lenders for funding to support innovative product ranges. In simple terms, securitization is the issuing of financial bonds against an income stream, such as the monthly payments due from mortgage customers. In most cases, a special purpose vehicle becomes the issuer of the bonds and holds mortgages, and as such takes on the risk attached to the mortgage loans. In the case of mortgage securitization, a quantity of mortgage loans are grouped together in a securitization pool and then repackaged into tradable securities in the form of bonds. The bonds are then sold to investors to free up capital that can be used to repay the outstanding balances on the lender's funding lines. So when the capital markets closed, this meant that specialist lenders suffered from limited monies for diverse product ranges. The markets have opened up since the pandemic, with a number of successful securitizations made, such as by Kensington and Belmont Green. So why have I explained all of this? Experiences have impacted our lives and our recent decisioning for a variety of matters, and these have ultimately fed into underwriting practices. As we saw when the mortgage industry went through the crash in 2008, the FCA coined the phrase responsible lending. Albeit the pandemic is not a liquidity crisis, responsible lending is still at the heart of this. Affordability, I think, has certainly taken on an additional meaning to ensure a customer can make their first mortgage payment, and that we are able as lenders to comfortably say to ourselves that that customer is able to afford their mortgage both the short term and in the long term. And not only is there the experience, there is the unknown, which has also impacted underwriting. Will there be a second wave? Are customers' jobs secure following furlough? But this is not all doom and gloom, as I have some good news for you. So what is this good news that you say? I'd say the good news is twofold. Firstly, the market is starting to adapt and react to the changing pandemic only in support of trying to help our customers out there secure their mortgage needs. Complex is certainly the new normal. Why? Because millions of people have sadly spent months on furlough, taken payment holidays to get by, or lost out on income. And this is even before you consider those customers who are self-employed, contract workers, or people who have previously had a record of adverse credit. But the good news is that the role of the specialist broker has never become so prevalent before, helping those customers with complex needs to identify which lender can help them secure mortgage funding. And also, there are lenders out there, more lenders in fact, week on week, willing to actually help customers with these complex needs. So although the good news is that the market is starting to open up to react and adapt to change, there are still going to be a lot of lenders out there who are unable to help those customers with complex needs. Why? Because their systems are automated and cannot get under the skin of each case to really understand that customer's complex needs. Which is why those lenders who offer a manual underwriting approach will win. The human approach, really getting to understand what is going on in that customer's lives, is paramount. And at Pepper Money, we really do embrace manual underwriting. And this can be seen by two ways. Firstly, you can get direct access to a named underwriter who is the mandate holder. So what that means is you can actually talk through a case, detail by detail, giving them a scenario of exactly what is going on in that customer's lives and how we can try and help them, both in the short term and in the long term. But secondly, our online portal has a send a message functionality, which enables you to write as much information as you'd like about that customer, so we can really get to grips with what is going on and how you would like us to help. And some other tips actually that can help boost your customers' affordability. So firstly, we have no volume limit on county court judgments and defaults. Debt to income ratio is not used to evaluate affordability. And we don't use credit scoring as part of our underwriting process, which again illustrates the importance of manual underwriting, particularly at this time when more questions are needed or more documentation is needed to evidence a client's affordability. Missed payments are considered as long as none are missed also in the last 12 months. So here I'm going to talk about an example of where manual underwriting has really come to the fore to really help a customer with their circumstances. So having finished his plumbing qualifications and with some industry experience under his belt, Frank actually set up his own limited company. Now Frank used his savings to cover most of the initial setup costs, and whilst he never struggled to find work, a series of late and unpaid invoices in the business's infancy left him struggling to pay his own bills. And his credit report was littered with missed payments and eventually a default. Shortly after, he managed to secure some very lucrative contracts, enabling Frank to get on top of his finances again and even take on an apprentice. Much of Frank's work was concentrated in one area, quite some distance from his current home, so he was keen to move. But he was sadly disappointed to find that his current lender was unable to even consider an application from him due to his credit history issues. Fortunately, Frank found us. Well, in fact, actually, Frank found a broker that knew about Pepper Money. And our underwriter then understood that Frank's financial difficulties were in his past and could see that his business was actually thriving. Despite the default 14 months ago, we were actually able to provide him a Pepper 12 mortgage product, enabling Frank to secure his new home. So there is an example where the power of manual underwriting has come to the fore. Yes, we had to ask more questions because sadly, with the pandemic, we just really needed to understand whether he was able to sustain his mortgage in the short term and the long term, but we were able to realise his dreams where other lenders couldn't. So in summary, it is without doubt that underwriting has certainly become impacted by COVID-19. But this is not for the negative. We have seen more questions being asked, as well as increased documentation from the lender underwriter looking to lend on a case, but that is to ascertain a customer's situation to ensure that they are able to maintain their mortgage both now and in the future. And this derives from responsible lending practices, avoiding the issues that were faced in 2008. Broker partners, therefore, are needed more than ever as a result of a customer's circumstances not only becoming increasingly complex and specialist, but to also help them with the added complexities found in underwriting. Sadly, that is all that we have time for today. If you have any questions, please do not hesitate to email me on Mirakian@pepper.money. I just want to say thank you very much for listening, and if you have found this useful, why not listen out for Volume 5, which is due in a fortnight's time. And don't forget, there is a participation certificate that you can also request from us should you wish to evidence your listening today. Many thanks again. Goodbye.